All right. So now let's switch modes. So all of those that we just went through was us as the purchaser. We're buying it from the supplier. Now we need to look at what transactions will look like when it's us as the seller. Okay. So March 3rd, Net Solutions sells merchandise for $1,800. If it's a cash sale, meaning our customer pays us cash at the moment of the transaction, easy. Cash goes up with a debit, and we record. Wait a minute. Sorry. We record sales of $1,800. Remember, sales is a revenue account. Okay, it's just a different name than the revenue account we've been used to this point. I like it when they call it sales revenue. I think that clarifies things. I don't know why that's not really necessary. We also have to enter a second transaction. So here's an important piece of information to remember. Every time we sell, it generates two transactions. The first transaction, we have to show the amount we received from customers and record that as revenue, right? What the customer pays us and record that as a revenue. If they didn't pay in cash and we told them they could pay us later, then it would be accounts receivable and sales. But it'd still be the same thing, okay? I call this the retail transaction. It's the transaction with the customer. The second part of it we have to enter is the fact that our inventory is going down. Why is our inventory going down? Because we just sold stuff to somebody. And we have an expense for that inventory, which is the cost of goods sold. So we have, I call it the retail transaction and the cost transaction. There's always two transactions in any sale. How much the customer is giving me, and that's also revenue. So my cash or my accounts receivable going up and my revenue going up. And then how much inventory is going out the door and the expense of that inventory, the cost of goods sold and the inventory. Every time we do a sales transaction, 4 entries, okay, or 2, it's like 2 journal entries. A lot of times they'll do it in a single compound entry, but there'll be 4 entries happening. So here's, let's see. I'll jump a little bit. Okay. So another thing that we have other expenses that come as being a retailer. A big one for a lot of retailers is our credit card expense, right? We have to pay credit card companies. Think about how credit cards work. Maybe I don't want to offer credit terms to people because some people don't pay me or because I'd like to get my money right away or whatever. So what I can do is I can accept credit cards. With a credit card, now each consumer, each buyer goes out and creates a relationship with their own lender, okay? And that lender says, you can buy up to this much. If you pay us within 30 days, there's no additional cost to you. If you want to carry it longer, we'll charge you interest. So now as the seller, I can get paid usually within 2 to 3 days when somebody pays with a credit card. I'm going to have to pay a small fee to the credit card company, usually something like around 2% of the transaction, plus some sort of a monthly fee of like $50. That's pretty normal. So that's what businesses pay. They'll pay like $50 a month plus 2% of each transaction. Okay. So it lets me get my money quicker. It lets my customer get stuff when maybe they won't have money right away if they need it. And so it's kind of a win-win. And then the guy in the middle makes money on the interest and those transaction fees. And so it's a win-win-win. That's how people see it. Okay. So just recognize that usually at the end of each month, a retailer is going to have some type of credit card expense. Okay. You just get a statement from your supplier, or not your supplier, but your credit card company, your processing company, saying this is how much your fees were withheld this month. All right, if we make sales on account, it's going to look a lot like the sales we just had in cash, except now instead of debiting cash, we debit accounts receivable and credit sales revenue. And then we also debit cost of goods sold and credit sales inventory. So let me ask you a knowledge check. what would you say is the gross profit of this transaction? You remember what gross profit was?
7,000.
Where did you get that? Between what?
The cost of the sales.
Yeah. So each of the sales, what we sold it to the customer for, revenue account, minus the cost of goods sold is our gross profit. So on this transaction, they had a revenue of 18,000 and a cost of goods sold expense of 10,800. So the difference is 7,200. That was their gross profit on that transaction. Not their net income, because their net income covers all those other expenses. If you think about it, if a business were to have a gross profit equal to its operating expenses, we'd say that business was at a break-even point. They had brought in just enough after cost of goods sold to cover all of their expenses. That cost of goods sold is a special expense we call a variable expense because it's tied to your sales volume. The more you sell, the more your cost of goods sold will be. Whereas things like your rent expense or your insurance expense, those are fixed expenses. If you sell one item, you still pay $1,000 a month in rent. If you sell 10,000 items, you still pay $1,000 a month in rent. It doesn't change. So our goal is to set our prices so that we can make enough gross profit, right, which is our revenue minus our variable expense of cost of goods sold, to cover those fixed expenses and make the amount of profit we need to make to be successful. Okay, that's what we're doing. Right, if you think about it, like business, we have all these, like we give you degrees in it and everything, and honestly, at the end of the day, it comes down to are you bringing in more than your expenses? That's it. Now, there's lots of ways for us to try to do that, but honestly, that's all that. Sometimes I'll meet people, I'll help them with their business, and they'll be like, I don't even care if I make a profit, I just want to help the world. And you're like, that's adorable. But you've got to at least make enough to cover expenses or you can't really help the world. But you don't have to get rich. You know, I see lots of nonprofits that run at break even, but they at least have to cover their expenses or this great thing they're doing for the world can't be sustained, right? So you got to, I'm not talking about evil, filthy capitalism. I'm talking about making enough to sustain a business so that you can continue to provide the goods and services that are meaningful to you. I run a soccer league, right? We have to make enough to cover our costs so that we can keep providing soccer for kids. We don't have to get rich. Nobody's getting rich. We're all volunteers, right? But we have to make enough. All right. So remember, we had purchase discounts where we were the purchaser. There's also sales discounts. So now as the seller, we offer discounts to people. Again, if you think about that transactionally, it's going to be recorded differently because in the one case we're the purchaser, here we're the seller. So a seller can offer credit terms just like a purchaser. And so it's the same nomenclature, okay, 210 net 30, which is probably the most common, by the way, that's why they keep showing it, probably the most common discount. So assume Net Solutions sold $18,000 of merchandise to Digital Technologies on March 10th with credit terms of 210 net 30. The March 10th sale would be recorded as follows. So this business is using, there's sort of two ways of thinking about this, okay? Some businesses assume everybody's going to take the discount. So what they do is they go ahead and record all of their sales as if the customer is going to pay them within the discount period. And then if the customer doesn't take the discount, they do an adjusting entry to show that they got the whole amount instead of the discounted amount. Other businesses take the other strategy, which is to assume nobody's going to take the discount. And then if the customer does pay within the discount period, they do an adjusting entry to show that they gave the discount, okay? Really what dictates this is how often do people take the discount, right? In other words, is it more normal in your business for people to pay the full price or to do the discounted amount? And that will usually dictate how you enter these transactions. Either way is legal from a generally accepted accounting principle standpoint. They're just both based on an assumption, okay? All that matters is when we actually do get paid, it all has to come out right so we can adjust for that. All right. So this method, what I was just describing, the sale to Digital Technologies is recorded by Net Solutions at the most likely amount expected to be received. So their experience tells them their customers take the discount, okay? So they go ahead and record it. So this method of recording sales discounts is called the net method, meaning we record it at what we think we're going to receive, the net amount. Okay. You'll see others that do it at the gross method, where they just assume nobody takes it. Okay. So when they actually pay it, or actually get paid for it, I should say, their cash goes up, their accounts receivable goes down. So when you'll see when they actually get paid, there's no revenue entry, right? Because we did the revenue entry all the way back when we sold the merchandise to them. Because remember, we record revenue when we earn it. So when I sell it to you, I've earned it. Okay. All right. If Digital Technologies does not pay within the discount period, so they send us $18,000 in cash, we'll record our accounts receivable as the amount that was owed to us from what we recorded, and then the additional 360 we'll have to record as additional revenue. Okay, so that's the adjustment, so to speak, when they get paid the full amount instead of the discounted amount. All right. We also have refunds that we have to pay to customers. So typically what we do, so I'll just read through their little example here. Borman Enterprises return merchandise with a selling price of $3,000 for a cash refund. The merchandise originally cost Net Solution $2,100. So when we get a return, remember when we made a sale, we had to record 2 entries, one for our cost and the other for the amount of revenue we're getting from the customer. So if we do a return or a refund, you have to do 2 entries again to show that our inventory is going up by the cost of the inventory, and that our refund payable and our cash are going by the amount of the refund. Okay. Again, this sounds complicated. When you get into it, you'll work through it pretty easy. Let's see. So here's just some samples of journal entries to record refunds. So if the customer doesn't return merchandise, that's called an allowance in a lot of businesses. Customers will say, hey, this is broken, and instead of saying send it back so that we can deal with it, we write just keep it and we'll send you a refund. That happens a lot. Okay, you probably had some transaction on Amazon like that where you've written to them and said, I want to return it, and they're just like, no, we don't want to have to deal with the cost of dealing with a broken thing. We'll send you money. So anyway, so these are just some samples. These are in the book of the various types of entries you'll see with these.